Hello and welcome to the Monday Futures Market Outlook for October 29th, 2012. This is Patrick Ceresna. For those of you that have not tried our eMoneySource.com trading room, complimentary memberships are available on the website. Also, those of you that enjoy our intermarket perspectives on the markets, we do have newsletters that publish analysis on the broader forecasts of the futures markets. Visit our website at markettimingstrategist.com. As always, we start off with a chart of the U.S. dollar index futures, and we have a U.S. dollar that's been strengthening in the last week, and certainly has bounced back up toward its highs. We still anticipate there to be further strength in the U.S. dollar, as it could very naturally retrace all the way back into the 81 to even 82.5 area in the upcoming weeks. Overall, we're not at this point certain whether or not the U.S. dollar can begin another leg higher in a big uptrend. But let's start off with just seeing how high it can muster off here and how it behaves at those higher prices to define whether or not something more significant is occurring. Next, when we take a look at the euro has actually held supports pretty well, even though we've seen almost 7-8 days of sustained selling. The euro has not broken its key support lines, which are around the 28.50 level, where all the lows came in September and early October. We do believe that there is a legitimate chance that the euro can break this, but certainly has impressed us so far as it hasn't really accelerated to the downside. We'll be watching how it behaves at these support lines. It will only become very concerned if it does actually technically break to a lower low. But if it does, then the pullbacks down to even 126 on the downside become quite possible. Next here, when we take a look at the 30-year Treasury bonds, we have a very indecisive market here. Starts off to the downside, quickly comes back to the upside, and really has very little committal to making its next major move. At this stage, we respect the primary uptrend in the Treasury bonds, but we need to see some price action that is optimistic in order for them to move higher. While a lot of people are skeptical of interest rates being able to go any lower, reality is that as we see many of these commodities selling, the deflationary pressures are non-existent, which allow interest rates to continue to drop further, especially with Fed intervention. And so we'll be watching whether or not the bond prices can still make a burst higher here. Next here, I want to take a look at copper prices, and copper has deteriorated in price quite substantially. We were looking for support around that 355, and that weakness has really accelerated down into the zone. At this stage, we do expect there to be somewhere a market bounce, but anything that really deteriorates much lower than here would mean that the next major support may not be until its lows near 3.25, 330. We do think that copper overall will stabilize somewhere down at these lower levels. We were looking for a correction off those highs, and so really at this stage it's just about where these support levels come in. Next here, when we take a look at crude oil, crude has materially weakened in the last 5, 6, 7 days, with us now substantial trading below the 89 focal point. Really, there is always the chance a short-term support can come in here, but more than likely the prices of crude are vulnerable to trading all the way back down to June lows, down in the $78 to $80 area on the downside. And so while certainly there are people that are looking at whether or not to buy the dip on crude, we would at this juncture suggest waiting to see where prices stabilize before dabbling in trying to buy crude. Next year, when we take a look at gold futures, we've been anticipating gold to come off of its highs, but we were talking about it being a buying opportunity. Really, at this stage, there's nothing stopping from gold even dropping another $50 an ounce in the upcoming weeks. But overall, this blue box zone in the 1700 to 1650 area is an area where we believe gold will be accumulated, and that's where a short-term low may most likely develop. And so we'll be watching for, as gold weakens here, where the opportunities to buy the dip may develop. Next year, we'll take a look at the S&P 500, and we now know that the markets are going to be closed for the next day and potentially next 2 days in the U.S. because of Hurricane Sandy, and this weakness here in the market that's coming in this morning will come with a market closure. At this stage, we do still anticipate the markets to still be vulnerable to further weakness, as a natural market correction is anywhere from 5 to 10%. Could easily see us drop to even as low as 1340, 1380. There's always a chance that this could develop into a market crash, but if we see price stability into short-term weakness into those zones, it may actually emerge as a buying opportunity. So we'll be watching to see where the short-term lows develop, and we'll be looking to see whether or not that emerges into that buying opportunity. Just to quickly review our key intermarket observations, we continue to view the U.S. dollar as a good risk-reward proposition, but commodities at this point, with them weakening, we actually may be interested in changing that to a good rating over the next month. But we're going to wait to see how low commodities go before we start looking at the risk-reward proposition of accumulating those commodities. We still are mixed on U.S. bonds, but we could very well turn bonds into a more optimistic risk-reward proposition if we see trend develop. Same with stocks. We've had a rating on U.S. and global stocks as being poor, but now that we're accelerating to the downside, we've changed that to average, and we're going to wait for another week or two to see whether or not that becomes an opportunity to accumulate stocks, which would have change our rating from the short term to a good risk-reward proposition to buy stocks. That was your Monday Futures Market Outlook. Thank you for joining me.